Tonight, we begin with a move that U.S. officials, financial elites, and global trade analysts had feared, downplayed, and quietly tracked. A move that unfolded not over decades of slow decline, but in a matter of months. Months that reshaped how global trade is settled. Months that forced Washington to reassess its economic leverage. And months that signaled the most serious challenge yet to dollar dominance. What China did crossed a line that U.S. policymakers and international institutions had hoped would hold indefinitely. And when that line broke, the rest of the world did not hesitate. They responded with realignment, experimentation, and recalculation. For more than a decade, there had been signals, not formal declarations, not official ultimatums, just quiet, persistent indicators that China was preparing something structurally disruptive. Beijing has been patient, yes, but it has also been methodical in that patience. Its economic moves followed a recognizable pattern, a sequence, almost a doctrine. Reduce vulnerability, build alternatives, test quietly, scale decisively. What set off alarm bells in Washington and global financial centers this time was that the pattern suddenly went silent. Experts who monitor currency settlement data, trade invoicing, and reserve flows know the indicators. Rapid growth in yuan-denominated trade, expansion of bilateral currency swap lines, increasing use of non-dollar clearing systems, and the sudden absence of reassuring rhetoric. All of that went quiet. And whenever China goes quiet, it usually means the groundwork is finished and something is about to move. Early this year, international trade and financial authorities detected what they described as a coordinated acceleration in non-dollar trade settlement, including large-scale contracts priced and cleared outside the dollar system that had not been normalized in over half a century. These are the kinds of shifts China only deploys when it is signaling something very specific. Strategic independence. Long-term insulation from sanctions, or preparation for systemic fragmentation. Observers did not immediately know which category this fell into, or whether it fell into all three simultaneously. But what they did know was this: China was changing its trade and monetary posture. And when the world's largest trading nation changes posture even incrementally, the entire system feels it. The response from Washington was not theatrical. It was not calm. It was not routine. It was urgent. Officials speaking after G7 meetings, Treasury briefings, and IMF consultations described China's move as strategic, asymmetric, and most importantly, system-altering, because it bypasses leverage without confrontation. Dollar dominance only works if trade continues to flow through it. China did not attack the system. It stepped around it. Within months of China's expanded non-dollar trade push, U.S. officials began warning allies about fragmentation. Treasury reassessed sanctions' effectiveness. Financial institutions were urged to maintain dollar usage, and diplomatic pressure quietly increased. These were not symbolic reactions. They were containment efforts launched only when control begins to slip. Tonight, trade and financial data confirm that China's shift was neither symbolic nor temporary. China moved before Washington could counter. They expanded yuan settlement in energy trade. They deepened local currency agreements with partners. They scaled digital and alternative clearing channels. They hit trade invoicing. They hit settlement infrastructure. They hit financial intermediaries that make the dollar unavoidable. In other words, China targeted the operational core of dollar-based trade, the component that makes U.S. financial power automatic. This is what made Washington's reaction so urgent. China's move wasn't rhetorical, it was executable. It represented the kind of action that could permanently reduce dollar usage if left unanswered. And Washington, understanding that fully, responded with speed. Not recklessly, not publicly, but strategically. They didn't sanction China. They didn't trigger escalation. They tried to shore up the system. Here is where the story becomes even more consequential. According to critics like Yanis Varoufakis, China's move exposes a deeper flaw in the global system. Varoufakis has long argued that dollar dominance survives not because it is efficient, but because it is unavoidable. Sanctions, trade, finance, payment systems, debt markets, all roads led through the dollar. China's strategy is not to overthrow that system overnight. It is to build parallel roads. China wanted to test whether the U.S. could stop trade from moving elsewhere. The answer came quickly. Washington could warn, it could pressure, but it could not prevent diversification. And that response was so measured, so rational, that it delivered the strongest signal of all. The world is no longer willing to place all trade inside a single monetary basket. That matters because trade, not finance, anchors currency dominance. And trade is moving. As reports continued coming in throughout the year, the scale of China's move became undeniable. Energy exporters settled more contracts in yuan and local currencies. Asian and Middle Eastern partners expanded non-dollar swap lines. African and Latin American states diversified trade invoicing frameworks. This wasn't collapse. This wasn't revolt. This was rebalancing. This was multipolar trade finance. And multipolar trade is the one thing the dollar system struggles to monopolize. For every trade rerouted, U.S. leverage thins quietly, but permanently. Remember, U.S. policymakers assumed China would remain dependent on dollar trade. Alternatives would be inefficient. Partners would prioritize U.S. stability over autonomy. But tonight, the opposite is happening. Dependence is shrinking. Inefficiency is being tolerated. And autonomy is being prioritized. What makes this moment so volatile and so revealing is that China's move comes as U.S. leadership faces mounting pressure. Domestic politics demand growth, allies demand stability, markets demand predictability, and rivals demand space. Washington is balancing all of this while managing inflation, debt, and geopolitical rivalry. And when leaders in that position face quiet systemic shifts, they don't react from strength. They react from constraint. Official U.S. statements framed the situation as manageable diversification. That is diplomatic language for, we see the risk and we are trying to slow it. You don't hear that tone unless something foundational is being tested. Meanwhile, Chinese leadership addressed domestic and regional audiences with confidence. They spoke of currency sovereignty. They spoke of balanced trade. They spoke of shared stability. These were not slogans. They were signals from a system that believes it is ready. Here's what makes the situation even more concerning for Washington. China's move did not happen alone. Alongside it, BRICS partners expanded non-dollar trade mechanisms. Regional blocs strengthened independent payment rails. Strategic competitors coordinated financial autonomy, all within the same narrow window. When multiple actors move together, it means the system is being quietly rewritten. Analysts now see three paths ahead. 1. The dollar adapts and remains central. Another, global trade becomes genuinely multipolar. A third, U.S. leverage erodes faster than expected. Today, the world is preparing for option 2 while hedging against 3. This is now a test of economic power. China wants resilience. The U.S. wants relevance. Trade partners want flexibility. And markets want certainty. Sources say non-dollar settlement continues to grow. They say Washington is coordinating responses. They say the dollar remains dominant but no longer exclusive. That alone changes everything. As the coming years unfold, more data will confirm what is already visible. China's move did not crash the system. It did not declare war. It changed direction. What happens next depends on whether the U.S. adapts or resists. And tonight, for the first time in decades, global trade feels genuinely flexible. Markets are calm, too calm. And when markets stay calm during systemic change, it means adjustment is underway. Because tonight, the world learned something fundamental. Trade is power. Currency follows trade. And no system remains dominant forever. This story is far from over. But tonight, one thing is clear. The dollar still matters, but it no longer stands alone. And the rebalancing has already begun. And we will be here watching every signal, every shift, every response, as the next phase unfolds.